Welcome back to The Explainer, everyone. Okay, today we're diving into a European telecom heavyweight that has been absolutely dominating the financial headlines lately, Deutsche Telekom AG. Now, if you follow European markets, you already know this company is an undeniable giant. But right now, there is a massive mystery surrounding its current stock performance, and we literally have to unpack it.
So here's the million-dollar question for today. Is Deutsche Telekom a massive, long-term buying opportunity? Like, are we looking at a true deep value play here? Or is this a value trap? Are there serious risks lurking just beneath the surface of what otherwise look like totally stellar fundamentals?
To really get why this is such a head-scratcher, think about this. The stock is perplexingly down about 15% from its February highs. Now, usually, you'd expect that kind of haircut if a company was, seriously struggling. But DT just beat earnings expectations. Their revenue is actually up, and they literally just announced a massive €5 billion share buyback. So, what gives? Why the drop?
All right, here is our roadmap for The Explainer. We're going to hit the telecom disconnect, check out the latest headlines, and break down the valuation. Then, we'll objectively weigh the bull and bear cases before synthesizing our final takeaway.
Part 1. The Telecom Disconnect. Great news, dropping stock.
Moving right along to Part 2. The latest headlines and what you actually need to know. Okay, let's look at the facts. On August 6, management dropped what I can only call the buyback bombshell. They expanded their 2026 share buyback program from its previous baseline by an additional €3 billion. That brings the expanded total all the way up to €5 billion. Guys, that's a 150% increase. And the catalyst for this? Well, they actually raised their full-year free cash flow guidance to roughly €20 billion. Management is clearly super confident in their ability to just generate sheer cash.
Now, the breakdown of their stellar second quarter is genuinely fascinating. Revenue hit €29.93 billion, which is up 4.4% year over year. Adjusted EBITDA AL grew 7.5% to $11.82 billion, beating consensus estimates. But here's the real kicker. The absolute engine behind all this growth, it's T-Mobile US. It now contributes nearly 70% of the entire group's EBITDA, growing at almost 10%. The US business is, without a doubt, absolutely carrying the weight here.
Beyond the earnings themselves, there are two major strategic moves you really need to be aware of. First up, they're actively expanding their European footprint, having just agreed to buy Polish fiber providers FiberHost and EF for about €1 billion. Second, and honestly this one's maybe a bit more surprising, early-stage talks about a full combination with T-Mobile US have officially ended. Now, this would have been the largest public merger ever, but it fell through simply because T-Mobile US didn't support the deal. So, for now, the focus is strictly back on organic and bolt-on growth.
All right, Section 3. Valuation and market reaction. Trading at a discount.
So, keeping those mostly positive headlines in mind, shares did surge briefly after the buyback announcement, but they still sit around €29, which is well below that €34.35 peak. And honestly, this brilliantly illustrates exactly why value investors are circling right now. The trailing PE is 15.4, sure, but the forward PE drops all the way down to 12.1. Why? Because analysts are projecting nearly 13% annual earnings per share growth. On top of that, the EV to EBITDA sits at roughly 6.0. So that means it's trading at a discount to both its own 10-year median of 6.31 and the industry median of 6.86. Basically, you are looking at Europe's largest telecom on sale.
The crucial takeaway here is honestly just staggering, €10 billion. When you combine that expanded €5 billion buyback we just talked about with their regular dividend, which yields an attractive 3.6% to 4% by the way, you get an absolute monster of a total shareholder yield. Roughly €10 billion is slated to be returned to shareholders in 2026 alone. If you're an income-focused investor, that is a highly, highly compelling proposition.
Which brings us to Part 4, the bull case. Why analysts are buying.
So the analyst community has definitely taken notice of that yield. Out of the 17 or 18 analysts covering the stock, the consensus is just overwhelmingly positive. The vast majority rate the stock a buy or a strong buy. And get this, there's not a single sell rating on the board, 0. The average one-year price target ranges from €37 to €42, representing a massive implied upside of 36% to 41% from current levels. And we're talking major global financial institutions here, JP Morgan, Deutsche Bank, Citi, UBS, all maintaining their buy ratings.
To quickly summarize the bull case, it really stands on 3 core pillars. Step 1. It's a cash machine. Like we said, the US business is firing on absolutely all cylinders, guaranteeing robust free cash flow. Step 2.
It's a very attractive entry point. You've got a forward PE of 12 against 13% EPS growth, which gives you a PEG ratio below 1, and that is a classic value signal. And step 3, insider confidence. Management is actually putting their own money on the line here, which we saw recently with an opportunistic share purchase from a board member.
But hey, markets are always forward-looking, and it's never all smooth sailing. Part 5, the bear case, the risks you can't ignore.
Let's impartially switch perspectives here. Risk number 1, regulatory headwinds. The European Union has proposed the Digital Networks Act, and this could impose much stricter rules on Deutsche Telekom's wholesale business right in their core home market of Germany. Now, management is betting on some sort of compromise, sure, but unpredictable EU regulations are a serious overhang. They directly threaten pricing and margins, and that kind of risk, it just doesn't disappear overnight.
Risk number 2 is purely execution. Deutsche Telekom is making a multi-billion-euro bet on building out this massive fiber network. But right now, only 18% of available customers have actually signed up for it. When you compare that to a roughly 30% adoption rate for their competitors, it's a pretty stark contrast. If those take-up rates don't start improving soon, the return on this incredibly massive capital investment is going to be way lower than expected.
And finally, risk number 3 is broader volatility in sentiment. This stock has fallen over 10% in the last 52 weeks. While value investors might look at that and see a golden opportunity, it also reflects very real macro risks. We're talking things like interest rates and potential economic slowdowns. Look, this investment is not for the faint-hearted. It is heavily, heavily tied to the broader regulatory and economic environment.
Okay, Section 6, the final takeaway, synthesizing the scale. So where does all this objective data actually leave us? Let's weigh the evidence. On one side of the scale, the bull case is just incredibly compelling. You have a totally undervalued cash machine, a super generous capital return policy, and strong double-digit earnings growth. But on the exact opposite side of that scale, the bear case holds some really heavy tangible risks. Unpredictable EU regulation, a pretty sluggish 18% fiber adoption rate, and of course, macro volatility.
Based on the analysis of our sources today, here is a quick framework to help you make your own informed decision. For an investor with a 3 to 5 year horizon, the risk-reward ratio actually looks pretty favorable. The current valuation does provide a real margin of safety. A prudent approach here might be to consider a small position right now and then maybe add on any weakness below 28 euros, because if fiber adoption accelerates and the EU regulatory picture clears up nicely, an upside to 40 euros or more is highly realistic. Just be absolutely sure you are closely monitoring those quarterly fiber subscriber numbers.
Now, as always, this explainer is strictly analysis to help you understand the landscape. You've got to do your own research. But looking at these deep discounts weighed against some very real execution risks, I've got to ask, are you buying Deutsche Telekom at these levels? Let that question guide your own deep dive. Thanks so much for learning with me today, and I'll catch you in the next explainer.